Welcome to the DeFi podcast, where we attempt to imagine the future of crypto, because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
Hi, everyone. This week we have Rhett on the podcast, who has a background in machine learning and decentralized finance. He is the senior DeFi specialist at Wave Financial, which is a leading crypto asset management firm. And today we're going to talk about everything that's happening in the market. Welcome, Rhett.
Welcome. Thanks for coming on.
Thank you. Glad to be here.
So, yeah, Jared's getting a little tired about talking about the market every week, but I think we just we continue because the story is still developing, right? Like at first so 3AC is blowing up, but the first week we sort of knew that it was happening, but we didn't know why. I think now there's more information coming out, so it's becoming more and more interesting. So we've seen, a lot has happened. We've seen USD fall, then we've seen 3AC take a fall, which seems to be dragging down Celsius, Voyager, BlockFi, and there's also been an issue with Bancor, and there's also Solend. So tons of different things are happening.
Oh, we can add Harmony to the list.
Yeah, Harmony.
The Harmony bridge just got hacked.
Oh, did it? I did not know that.
Yeah, that was
been off Twitter for an hour.
Oh,
really? Oh, yeah. Okay.
Yeah.
I completely missed that.
That exploit also by Lazarus Group. That's the North Korean hacker group.
I would say a hack is a bit different, though, than everything else that's going on.
True.
I would sort of put it in a different class. So Rhett, which part of everything that's happening right now do you find most interesting?
So a lot of it's linked. So the UST, 3AC, and then the centralized kind of crypto banks are all kind of pretty closely linked, and I think there's some interesting stuff there. The Bancor one I find really interesting. It's smaller, but I had some personal interactions with some Bancor people, and it's interesting that project's been around for so long, and their mechanism, in my opinion, was so obviously flawed that is interesting that it stayed around for so long. Bancor is this DEX that claims to be as good as single-sided lending, but you get really high yields. So you say, hey, I want to earn stablecoin yield. They can give you 15+%, which is pretty good in today's market. And you're really providing liquidity between, say, USDC and BNT, but they have this method of protecting you against the impermanent loss or price divergence loss, where if you didn't make money providing liquidity because of price divergence with the BNT token, they will mint more BNT and give it to you to kind of insure against that. The problem,
they're protecting you against the IL, or
yeah, exactly.
That's what you mean by price divergence?
Yeah, exactly.
Yeah, you can correct me if I'm wrong, but I previously summarized to JF that I see Bancor as kind of what Luna was to UST, Bancor was trying to do to LPs.
Yeah, in a lot of ways. Because they have very obvious death spiral risk, in my opinion.
Right.
I actually, I was at Permissionless in Florida a couple months ago, and met some Bancor guys. They had a big booth there, and Wave manages a stable coin fund. We call it the stable asset yield fund, and their yields were really competitive for stable coins. And I'm like, can I justify putting any money in that? I don't think so, because their mechanism seems really problematic. Met with one of the guys, and I'm like, okay, convince me that you don't have death spiral risk, because the problem is if BNT token starts sinking, they mint BNT to give to you to make up for that, and then that causes a bunch more inflation, and then you dump that, cause it to sink even further, and you just obviously get into this death spiral. So I was kind of like, talk me through how that's not a problem. And the guy was like, well, I'm not the expert. We have a team of economists that seem to think it's okay. And I'm like, well, I'd love to talk to them. And so I was planning to connect with their team of economists to see if they could convince me that this isn't a big problem, because the yields were high, but I just was like, this is kind of seems unsafe. Anyway, they did basically get into a death spiral not too long after that. And you have kind of two choices, like let the entire system implode or turn off your IL protection and say, we're basically going to break our fundamental, like our foundational promise, which is what they did. So I actually hopped on a Twitter Spaces where the founder was talking through this, and I hopped on and said, "Hey, I've talked with some members of your team, and we manage this fund, and I just couldn't get comfortable. It seems like you have pretty obvious death spiral risk." And he was like, "Yep, no disagreement." And I was like, "Have you thought about IL protection in other ways? Because there are other kind of things you could potentially do where you say, hey, the fund or the protocol itself is going to take a cut of LP fees and then throw it into a treasury, and then those who experience IL will pay them extra out of the treasury potentially. Or you could have dynamic liquidity provider fees go up if there's more IL. Or
Sorry, just before you continue, did you say that you actually brought it up to their team and they kind of acknowledged it, but just what
their
they
founder, this was a Twitter Spaces with their founder.
Okay.
I
Kind of concerning, actually.
Yeah, this was after they had turned off IL protection, basically. And I was like,
Right.
you kind of, I had this conversation. You seem to have death spiral risk, and he's like, yeah. And I was like, have you thought about doing some of these other things, or maybe even like using options? You can use options to kind of buy basically insurance for your LPs. And he was kind of like, yeah, the options thing would work if there were more liquid options markets, but it's not solved right now. And yeah, that would be a better method. But, there's not like options markets are too thin in DeFi, so can't really do it. And that was kind of his answer, which I felt like I actually appreciate the fact that he was honest about it. He wasn't like trying to argue that no, death spiral risk doesn't exist. It was like, yep, it does. And we basically have been experiencing it. So oops, but I was just kind of surprised that, Bancor kind of flew under the radar. Like a lot of like big people in crypto that I follow, after they turned off IO protection was like, wait, this was their mechanism? That seems very obviously flawed. I had learned about it before, seemed very obviously flawed, but Bancor's been around for like since the last cycle, and it just kind of flew under the radar of like, it didn't grow big enough for people to notice that their mechanism was kind of problematic. So
Yeah.
I don't think
It's like
I don't think they're going to survive really.
it's like this promise of saying we're gonna give you something that is fixed or that has a promise attached to it, and then we're gonna balance it with this other asset that is free floating that everyone can just sell as soon as there's trouble. Like, this is not a sound idea.
Yeah.
I like your solutions for how to solve it. I think the options one would be maybe a little costly, and then the yields would have to go down because options are just expensive, even in the whether there's liquid market or not. Like, options are just not free, right?
Yeah.
I definitely like the first solution where you have a treasury that it's literally insurance. Like, you're putting a little bit aside, and the group takes the hit for when there's a divergence on one of the assets.
Yeah, you can only have so much insurance, but at least you'd help blunt the blow. Every one of them, you're going to be giving up yield to protect, because I think IL is something I don't even think you can theoretically just get rid of. You can mitigate it, you can move it around, you can move who bears it, but you can't.
I mean, it's built into the equation, right?
Yeah.
As far as I can
exactly.
tell, I mean, there's no.
In traditional markets, market makers are really advanced actors, and earn their money for a reason, because these things just exist in markets.
I feel like it sounds like a lot of what happens in DeFi, which is these grand promises that don't really make sense. Like, we're going to pay you in the emission of the token that you are holding. So, like, we're just diluting it, and you're making a return. There's no return. We're diluting the token, right? So I guess in a bull market where everything is going up and you're super bullish on the token, getting a dividend in token form from that token. So the dilution can be attractive, I guess, technically, because you're thinking other people are not staking it or something. But anyways, it just, a lot of DeFi is a little, I think it needs to grow up a little bit. There's some really interesting things, but there's no free lunch, right? Like, maybe the only free lunch is that you have a technology that is going to make the markets more efficient. But
Yeah, I think
and you're
the
not
real
inventing
promise
money.
of DeFi is maybe the somewhat less exciting promise, which is like this is a way more anti-fragile system. And Robert Leshner talks about this in the recent chopping block episode, highly recommend, where he got really critical of the Celsiuses of the world and was like, through AC, Genesis, BlockFi, Celsius, they had a better path. They could have just used DeFi. It's not opaque, it's open, like it's transparent, it's has systems in place to kind of weather these sorts of things. And instead, they acted in the old way and ended up, creating this systemic risk like 2008 style. And that aspect of DeFi is delivering and is amazing. But in DeFi, you're right, when there's these really super normal yields and then most of it's coming from emissions, it's just not sustainable. And so one of my views in DeFi is if you have a yield of 100% and only 1% of that is coming from like actual economic activity in the system, and the rest is emissions, you don't have a business basically.
Yeah.
And so and you don't always have to have really high yields because that's not the only thing DeFi offers. Like Liquidity offers really low cost borrowing that's very safe. It's less about yield and it's more about if I have assets, if I have ETH I want to borrow against, here's a better way to do it than doing it on BlockFi.
Mm-hmm.
And they don't have to offer really high yields in order to be a business. Like they're taking the other side where they're like, we're just a more efficient way to borrow. And that's actually, I think those promises of DeFi are being realized in a really positive, powerful way. And honestly, I think the BlockFi killer and the Celsius killer is going to be like a DeFi mullet. It's going to be like a really lightweight business that just plugs into DeFi on the back end. And it's going to be kind of a boring business, low margin. You're like, you want to borrow against your ETH? We're just going to plug you right into Liquidity. And then we're going to charge you a fraction of what BlockFi charges you. And we'll take this very small uplift fee,
Yeah, absolutely.
It's kind of like the Warren Buffett approach. Just look for things that are fundamentally good.
Yep.
And, you know, don't get caught up in all the hype and all trying to chase ridiculous yields because those yields aren't really real.
Yep. I totally agree. Totally agree. Very high emissions are a red flag for me for DeFi protocols.
Yeah. So if you look at the kind of the base, you have sort of like the primitives, everything is coming from kind of a base layer of DeFi, and anything above that, there's something going on to just create that out of thin air. I don't think you're gonna get, unless it's like something that's really small and very niche, but like on a wide scale for like over $1 billion worth of deposits, you're not going to be able to achieve a 10% or more return on that because there just isn't enough activity. There's not enough. There's no reason to justify that rate, other than you're dipping into your own pocket to get the attention that brings. But one of the things that really kind of confuses me is I understand, these are sort of centralized private institutions and they have the ability to take risk, but why so much risk?
So this is an interesting one with so the 3AC guys, I think there's just some hubris there. I think they went from millionaires to billionaires over a few years because they took leverage and they thought, hey, look, we are smarter than everyone else. We can take leverage and not blow up. And now that we're so big, it's even safer for us because we can take leverage and we're so big we can move markets. And so it became, we can kind of make our own weather more so. And so it's even safer than it used to be for us to take leverage. That's my guess on the 3AC side. On the people who were the counterparties to 3AC, I think a lot of them just viewed 3AC as the smartest guys in the room and did less diligence on them than they would have if like I called them up and said I wanted to borrow money. And actually Wave experienced this where 3AC reached out to us and said, we want to borrow from you guys. We'll pay you X interest rate to borrow stables from you. And our head of DeFi looked at kind of the documents they gave and was like, you haven't given me enough information for me to feel comfortable, so we didn't lend to them. And they were kind of like, well, everyone lends to us, and like we're like obviously the smartest guys around, and you should lend to us like everyone else does. And it's one of those things where there can be kind of herd behavior even amongst like institutions. And we still chose not to. So luckily didn't experience any of the fallout that like BlockFi and Celsius and others have. But it's one of those things that like, if everyone just agrees that these people are the smartest guys around and they say, we want to borrow from you, you're going to just pay a little bit less attention to, their credit risks, or, than others might. And so, I think that's kind of part of what it is like, well, Genesis is lending to them and BlockFi is lending to them, and they are obviously crazy smart. So let's just go ahead and do it too. Where with the exact same information, you might not, if you just thought they're like, unwise degens or something like that, So I think that's that's kind of part of the issue, is maybe just a little bit of herd behavior and people trusting them too much. It's like if Warren Buffett called you up and wanted to borrow from you, you might just say yes, even without checking the details, because everyone agrees that he's smart and conservative and has a lot of money. And so you're like, I'll probably just trust the guy, And I think there was some of that going on.
Right.
Right.
This seems to be what happened.
Yeah.
How would you, do you want to talk about Solend?
Yeah. So that's an interesting one. So, Solana as a whole, I think, is actually kind of an interesting place where, Solana, they have effectively delivered on some of their promises, which is that they are a very low cost environment. But the other issue is that because they don't have fee market mempool, et cetera, they don't handle abnormal loads very well, and they go down occasionally. My view is a chain like that doesn't have always uptime is an appropriate place for some things, but most of DeFi it's completely inappropriate for. So I personally, and I think my guess is most institutions will avoid using DeFi protocols there until we're confident they have always uptime. Because even if you have a super solid protocol like MakerDAO or Liquidity, that are these lending protocols that have been able to maintain over collateralization even in the worst of times, if there's a market meltdown and the chain freezes, even those systems could go insolvent. There's no way to avoid insolvency for a lending protocol if you don't have always uptime. So I won't touch DeFi on a protocol that basically ever goes down. So that's kind of an issue that's kind of made it a little bit worse. Lending protocols are a little bit worse there. And actually, I have a coworker who was like, the only time I've ever been liquidated was on Solend, because he needed to kind of shore up his position, but the chain froze and he couldn't get assets in time, and then he got liquidated. And so that's problem number one. And then problem number two, and I think this is something to keep in mind for lending protocols, is there was the single position, borrow position against Solana. It was so insanely large that if they got liquidated and then that Solana got dumped onto the market, it could just absolutely nuke the price of Sol. And I think Solend got worried about it, so they basically passed a proposal to just take that borrower's assets and go do some over-the-counter deals in order to not nuke the price of Sol as they liquidated them. And then the market started coming back, and so they undid it, et cetera. So some people have been concerned that Solend is not as kind of permissionless or decentralized or whatever as kind of they had promised to be, which I think is a real criticism. But I think the bigger criticism, though, is if you're building a lending protocol, you shouldn't accept so much assets relative to the supply and float and liquidity of those assets. And so what you'll notice is like a lot of lending protocols, like on Ethereum, they'll have mint caps if an asset's like more thinly traded, where it's like, oh, we're going to facilitate, people. There's different types of lending protocols, right? So say it's the synthetic stablecoin version, like the MakerDAO Liquidity version. You say, hey, we're going to let people mint stables from this, from, I don't know, Ohm. We're only going to let them mint X amount, because if we let them mint like, $500 million from Ohm, and the entire market cap of Ohm is $600 million. If it ever started cratering, you could not liquidate people fast enough to keep the protocol afloat. So I think there's a problematic design element there, where Solend probably needs to come in and say, people who are borrowing based on asset X, they can only borrow so much against that asset relative to the liquidity of the asset in the ecosystem. And the only assets big enough to basically kind of take the guardrails off entirely are probably ETH and Bitcoin. ETH even more so, because Bitcoin is high market cap, but its liquidity is thinner than Ethereum's. But Ethereum has so much liquidity and such a high market cap that you probably don't need guardrails. And then maybe similar with if you're borrowing against certain stables like USDC or USDT, because they're really big and a lot of liquidity and they're stable. Everything else, you kind of need to have some guardrails on until the system matures more. And I think Solend was a little bit, that was a little bit unwise, in my opinion, for them to basically let someone borrow as much as they wanted against their soul. Whereas, like a more carefully planned system would say, here's the max borrow against this asset, and then we will raise that max as market cap and liquidity and maturity increase and volatility decreases. I think they're just a good example of how if you're designing a lending protocol on any of these markets, you just need to be a little bit more careful. So like similarly, like if I was looking at Bancor on Avalanche, and they're allowing kind of infinite borrowing against AVAX, and then some whale comes in and takes advantage of that, I would consider that concerning to the system.
Some of these things should definitely have been thought about before the instance has to happen, and then you have to take this decision, because I think choosing to make the decision to take over a person's position kind of destroys the idea that this is a decentralized system. And so I think what is going to end up happening is people are just going to completely lose trust in this specific protocol.
I think that's
Maybe
right.
just not even touch it, because it's just going to be too scary to try and get back into something when, they could make another crazy decision. Who knows?
Yeah, I think that's right. And I think it's a problem of Solend, not a problem of DeFi in general, because if you look at like higher quality DeFi protocols, they tend to be more careful in their design up front. Like Liquidity is probably best in class, MakerDAO is great, Aave is great. So it's one of those things where I think we're finding that and it's actually kind of links back to the whole Terra Luna thing versus MakerDAO. Do Kwon was always insulting MakerDAO, saying, by my hand I will die, and they were growing much faster, and they were capturing a lot of stablecoin market share by being so much more aggressive. And the Maker guys were like, we're just chugging along, and we're going to grow slowly, and we're going to grow safely. And a lot of people were insulting MakerDAO for that. And then Terra Luna blew up, and MakerDAO kept chugging along just fine. And I think it's a lesson for us that we should probably try to be more like, in my opinion, as a builder and as an investor in builders, I tend to favor things that will be really resilient in meltdowns more so than things that will like grow to the sky during up markets.
Well, maybe it's just a symptom of the environment, right? Because you look at Solana, for example. My main criticism of Solana is that they use some sort of centralized sources to do their block processing. And so, if you're looking at a chain that, on one hand, claims to be decentralized, but on another hand is actually using centralized factors to let it run, then maybe you're going to end up with people on that blockchain who are kind of doing the same thing. You're going to see a decentralized lending market, but on the back end, they would also be willing to go and do some. It's essentially like a centralized maneuver to just take over someone's thing. So I think the sort of crypto ethos of code is law should be strictly adhered to, because it's basically just the best practice. If you try and break it, you're going to lose a lot of credibility.
I agree with that. And I think you see that more strongly in some communities than others, especially in communities where at the layer one, so where you see at the layer one, there's a big emphasis on decentralization. You see a lot more of that culturally even. And then at the application layer where you see a big focus on immutability, you see a lot of that too. And you see that especially in some of the kind of OG Ethereum builders where like Liquidity, they didn't even spin up their own front end. They have no front end. Their token is a non-governance token because there's nothing to govern, because all of their contracts are immutable. Every parameter is fixed forever. They deployed it, basically said, whoever wants to build a front end, go ahead. And it's this kind of radically decentralized approach. And you see, like with Uniswap, they come out each they don't have upgradable contracts either. Uniswap V2 is fixed, and then V3 is fixed, and so on. And so some of the kind of builders that were kind of building from that older kind of, the people who have been around since from the earlier days where decentralization and immutability was like really kind of like culturally emphasized. You see that a lot more. And then, yeah, some of these newer builders where it's like, well, we want to get past kind of the slowness of Ethereum. So we're going to build this ultra scalable blockchain. We'll give up a lot of decentralization. And then we want to build DeFi protocols that'll give up a lot of that as well. I think you start losing some of that, and then those sorts of things struggle when there's hard times, which is why like Solana, I view at present, this isn't always going to be the case. I view it as a more appropriate place for non-financial applications. Like if I was going to have some, do some NFT stuff, I'm probably more comfortable doing it there, or like crypto gaming stuff, I'm kind of probably comfortable doing it there because the stakes aren't so high. But anything financial, me personally, I kind of I value decentralization more and resilience over fast growth, and then I obviously don't want a chain that'll ever go down. So those are things where I'm like, okay, at present I don't view Solana as a super appropriate place for like 90% of DeFi.
So, how are you and your team playing this market now that everything has happened?
We're ultra conservative, so we've always been pretty conservative. Like our stablecoin fund has not a crazy high target APY, and we weren't exposed to the UST thing. We haven't been exposed to some of these centralized counterparties, because that's an option that we have as an organization. Is we could go lend to Celsius, BlockFi, Genesis, etc., and we haven't been exposed to some of those things. We a lot of what we've been doing is like liquidity providing between some of the more solid stables in Curve and Convex. And that's like a common place for us to play. But we've actually recently removed basically all of our positions, and we're basically like, well, we're going to give up a little bit of yield and just kind of let the market play out a little bit. The 3AC thing is still kind of working its way through the system, Celsius, et cetera. And the market's just gotten a little bit more kind of volatile, even for stable coins, even for safer stable coins. And so we're conservative enough that we're fine giving up a month of yield to just be, safe, and to kind of capital protection is more important to us than maximizing yield.
So the interesting question is, how do you make that decision as to when to come back in? Is it just sort of a day-to-day wide analysis of the market, or I mean, there's some gut feeling to this, right, as well, or is it just purely quantifiable analysis? How do you process for that?
There's some quantifiable things and some not. So like for instance, part of the problem with the 3AC thing blowing up all these other entities is you don't know exactly how much exposure who had to what. And so as that plays out, as 3AC finishes liquidating as an entity, and then these entities come out and say, here's what our write down is, and here, then that'll give us some confidence that we know that there's not still a bunch of lurking insolvencies. So that'll be helpful.
It seems like these institutions ended up getting liquidated mainly just because they thought that Bitcoin couldn't go so low. Do you think that could happen again if it goes even lower? Like, are they getting strong enough to, let's say, be able to weather another 50% reduction, or are they just thinking that, okay, we've gone down, we're leveling out, now we've reached the bottom, so we're going to have a little bit of a barrier, assuming we're just going to go back up?
Yeah, good question. So I think you're right, by the way, and I think that's part of the issue of Three Arrows Capital is like they were always on all the podcasts that Suzu was on. He was like very bullish, and people thought that it was like him lying to people. But it turns out he was as bullish as he claimed, and they were levered long, and they thought market is up only, it's the super cycle, etc. When ETH fell to like just under 900 a few weeks ago, I think if it had fallen to 700 at that moment, there would have been more pain than if it fell to 700 now.
Yeah.
I think there is some kind of hope that we're getting some relief, and that we've kind of bottomed out. But I still am seeing a lot of systems getting less and less levered like during this relief period. So I feel like it feels like as a whole the market is saying, well, we hope there's relief here and that it doesn't nuke another 50%, which would be pretty crazy given how far down the market is already. But just in case, we want to kind of delever as much as possible. So I don't see a lot of like degen activity of like people saying, oh, we bottomed out, time to lever back up. What I'm seeing more is we bottomed out. I'm going to use this time that I've been bought to delever even more, either buy some ETH or Bitcoin or whatever and add to my position, or start paying down debt, or both. And so I don't see, you see that happen sometimes where things nuke and then people get bullish again and get ready to lever right back up. I might be missing something, but I don't think that's kind of currently happening, which is a good thing. You're going to grow more, you're going to have more stable growth and lower volatility if the system delevers a bit and then stays at a lower leverage position.
I just find it crazy to think that, you'd think these people who theoretically should be kind of like the best among us at dealing with the crypto market and its volatility and its movements, but they're just as degen as, the crypto bros going 100x leverage on Binance,
More of them
Yeah.
than you would think.
I think maybe it's a good place to end the show. I think we've kind of covered everything. Rhett, thank you so much for being part of this. That was really good. If you've been watching this far, please follow us on all the platforms and thumbs up on things. We love it, and Jared especially loves it. Okay, thanks a lot, guys. See you next week. Bye.
Thanks.